Welcome to the Farms.com Risk Management Educational Grain Commodity Market School video series. It's been a long year. We're almost close to the end. This video series being brought to you and sponsored by DeKalb Brand Seed to educate producers and farmers about grain commodity marketing. You can find us at marketschool.farms.com. In today's video, the 26th video, we're going to look at how to deal with a commodity broker. In this video, we're going to look at the role of that commodity broker. We're going to also tackle specifically what and how to place an order with that broker and actually what to say. Finally, we'll summarize what needs to be done once a hedge is in place. So, that futures commodity account, farmers need to call a licensed commodity broker. Unfortunately, you can't do it yourself in order to open up a commodity hedging account. There are many financial institutions that can help you set up that account. You can trade online for as low as $4 a trade, round turn, but only recommended for sophisticated hedgers. Following is a list of a few commodity brokers in Canada that can help a farmer open up that futures commodity account. So there's Freeburg Mercantile Group, there's the Scotiabank Capital Group, there's RJ O'Brien, there's Union Securities, there's Royal Bank, RBC Dominion Securities. So check their websites, compare fees. I have no favorite here. Again, the rule here with a commodity broker is really just trying to execute your trade at a very low cost. The role, again, is basically for them to understand and perhaps assist you in executing that hedging or marketing plan, providing you information on any technical features used to trigger perhaps futures or option contracts or positions, filling orders promptly and executing at a low cost, as I said earlier. Round trip, usually in and out, cost between $20 to $40. Full service can be as high as $70 plus. Again, if you're comfortable, if you've watched some of these videos, you understand what you're doing, you really don't need to hire a full service broker for advice. And finally, providing accurate and timely position records and monthly statements. So let's talk about placing those orders with that commodity broker. There are three types of orders when working with a broker. These are the three most common. The most common one is market orders, limit orders, which we prefer, and then stop orders. And we'll tell you why we prefer limit orders. Let's start off with market orders. Market orders are the simplest and most common type. You will want to use a market order when you want to get a fill quickly. When the market is currently trading at more or less, market orders have priority over all other orders, which simply means they would be filled before limit or stop orders. A market order does not specify a price. If you're trying to buy a futures contract, you will normally get filled at the ask price. If you're trying to sell a futures contract, you will normally get filled at the bid price. So let's go through an example. March 2012 corn is trading at $5.97. That's the bid price. The ask price is $6. If you place a market order to buy, you will probably get filled at the ask, which is $6. If you place a market order to sell, you're probably going to get filled at the bid price, which is $5.97. Hopefully you're still with me here. You will sometimes get bad fill prices when trading commodities, so don't always expect this scenario because markets tend to move around fairly quickly, particularly during USDA day reports where there's some important news that's come out and perhaps your limit up or down. One needs liquidity. Liquidity comes in a lot of the electronic markets such as the S&P 500, sometimes with some of the grain markets such as Western barley or perhaps canola, the liquidity is quite not there. Remember that markets can move quickly, so the bid and ask prices can change rapidly. Let's talk about limit orders. Limit orders are orders to buy or sell a contract at a specific or better price. Limit orders may or may not get filled depending on how the market is moving, but if they do get filled, it will always be at the chosen price that you've set or at a better price if available. Let's go through an example of a limit order. A farmer placed a limit order with a price of $14 a bushel. The order would only get filled at $14 or better if it got filled at all. Limit orders are used when you want to make sure that you get a suitable price and are willing to take the risk of not getting filled. However, farmer can use a minimum order and add a discretion. In other words, you could add a 2-cent discretion to this order, so it gives the broker some flexibility in filling that order. So he could either buy it at 14.02 or 13.98 per bushel. Let's talk about stop orders. Stop orders are similar to market orders in that they are orders to buy or sell a contract at a best available price, but they are only processed if the market reaches that specific price. Stop orders are processed as market orders. So if the stop or trigger price is reached, the order will always get filled, but not necessarily at the price that the trader intended. Stop orders will trigger if the market trades at or past the stop price. So for a buy order, the stop price must be higher than the current price, and vice versa for a sell stop order. Example of a stop order. If the market price is $6.50 a bushel, farmer might place a buy stop order with a price of $6.55. If the market then trades at $6.55 or above, the farmer's stop order will be processed as a market order and will then get filled at that current best price. Similarly, if the market price is $6.50, a farmer might place a sell stop order with a price of $6.45. The market trades below $6.45 or lower, the farmer gets filled on that stop order. Stop orders usually are used to either protect a profit or limit a loss. So I don't tend to use a lot of stop orders because when it comes to hedging, you're not really concerned about the day-to-day moves. You're not really speculating about the movement of a futures contract. You're really in it for the long haul. Let's look at an example of hedging selling futures. So we're going to teach you how to place the order in, how to place that hedge, and then what to do with that hedge once it's in place. So for example, a farmer wants to hedge 5,000 bushels of corn in June that he or she expects to harvest sometime in November, December. The farmer would call that commodity broker and say, please sell one 2011 December corn futures contract at $6 a bushel with a 2-cent discretion, allowing the broker to either sell that futures contract at $6.02 or $5.98. You can also place that order in as a day order or as a good till canceled order, or you can also put in a specified date, a specific date. The ICE exchange is not allow specific dates, whereas the CME does do that. And that good till canceled is indefinite, and you can use 60 days, 90 days, whatever your preference. The same farmer could have soybean bushels to hedge, and so he could call the broker up and say, I'd like to sell one November soybean futures contract at $14 per bushel with again, maybe a 5-cent discretion, so that broker could sell that futures contract at $14.05 or $13.95. Hopefully you're with me here. Now, if you're not comfortable using futures, you can also hedge using put options. It's similar to selling futures, except you have a known risk. We've talked about futures and options in earlier videos, so just check those out if you want to get up to speed a little bit on futures and options. For example, a farmer wants to hedge 20 metric tons of canola, or it works out to about 881 bushels, in June that he or she expects to harvest in September. The farmer would call his broker and say, please buy one 2011 November canola put option, strike 600. And let's say it's trading at $30 per contract with a $2 discretion, so the broker could purchase that put option at $30, $32, or $28 per contract. Remember, again, you can put in that order as a day, a good till cancel, or a specific date. The same farmer could also have some wheat bushels to hedge, and that we could call the broker and say, please buy 1 September. You're buying, not selling, okay? Buying 1 September, $6 Chicago wheat put option strike, $6. And we would pay about 60 cents per contract. Let's assume the market's trading at 60 cents, and we perhaps give a 5-cent discretion, so we could buy at 65, 60, or 55 cents per contract. Each contract covers 5,000 bushels. So let's give you some rules to follow here. So once you've placed that order in place, once you've maybe sold some futures. When placing the order with a commodity broker, make sure you follow up. Okay, so maybe you haven't got the fill yet, waiting for a phone call. Please follow up with the broker. They get busy. Sometimes they don't have time to call you back. So it's really your responsibility to make sure that that order really gets filled, because markets will move fairly quickly. Once an order is filled, ignore the noise until the physical commodity is ready to be delivered. For example, a farmer shorted one corn futures at $7 a bushel, but did not harvest until October. When October rolls around and he's ready to deliver those bushels to the local elevator, he then buys back that futures position. That's a perfect hedge. If you do not do that, you then become a speculator. Treat it as a hedge. Do not let the broker talk you into doing something else. Otherwise, again, it's speculation. Unless the fundamentals have changed dramatically, maybe you might want to do something, but until then, treat it as a perfect hedge. If the broker calls you, convinces you that perhaps copper's going through the roof and I should get in on the winnings, again, ignore the phone call. That is pure speculation. So, in summary, having a commodity broker that understands your risk management plan, your hedging plan, marketing plan, can have a huge impact to your bottom line. The ever-increasing volatile, changing commodity environment in the future will require that each marketing plan have a commodity account as part of that plan to manage and navigate through the highs and lows. Remember, commodity accounts are used only to hedge, not to speculate. If you decide to speculate, please keep them separate. Please see videos number 11, 12, 18, and 19 for more details on futures and options. In our next video, we're going to put it all together for you. I'm going to create that action plan and summarize all the key takeaways from the 27 videos produced so far in 2011. Thanks for watching. Hopefully we've entertained, educated, and inspired you today with our topic, dealing with a commodity broker. We look forward to seeing you next time. Take care.